Thursday's price action, I'm not sure what to say about it. At one point, the NASDAQ was up over 7%, technology 8%, and all across the screen, there were stocks up 15 to 20. The headline CPI was cooler than expected, coming in at 7.7% year on year. But the real excitement came from the core, coming in month over month, half of what the street was expecting. So what does this all mean for investors? Let's find out. Welcome to the Money Runner. This is your Market Minute. I'm David Nelson. Market bottoms often start with a monster move like we saw Thursday, but all too often they fail in the weeks ahead. Let's look at the setup. I think Wednesday's sell-off the day before was only partly in response to the failure of a red wave that investors had largely priced in. What really drove the markets to the lows was the headline stories of a potential fraud at crypto exchange FTX. Sam Bankman-Fried, founder and CEO, says they need a $9 billion rescue. I'm not going to go into the details on that. I'm going to cover it in another pod. But I expect the DOJ to investigate. I think CNBC made the right call saying this was a Lehman moment for the crypto industry. Nevertheless, the setup was good as many, including yours truly, reduced exposure going into the print. Any good news was likely to set off a buying frenzy. By noon, we had taken out the 100-day moving average, an important resistance putting the 200-day in play. The dollar, which has been key all year, collapsed, giving large-cap secular growth the fuel to have one of its best days in years. Remember, 40% of S&P 500 revenue is generated offshore. A rising dollar has been kryptonite for growth companies, as some of the biggest, including Apple, Google, Amazon, Microsoft, and others, generate 50% or more of their revenue from outside the U.S. We really only have maybe two major data points between now and the end of the year, both next month, with another CPI print and Fed meeting back to back. If these levels hold, maybe we can see some upside between now and the end of the year. Look, the setup, the price action, and even some of the other news circulating the street has been supportive. Some talk that potential peace talks in Ukraine have improved, even signs that China might soften its zero-COVID policy. And I'll be the first to admit that market bottoms are usually faded as some of the smartest guys in the room hold on to their bearish thesis. I said a couple of weeks ago that bears will overstay their welcome just like the bulls did. However, I want to leave you with one sobering picture and an important date. January 3rd, 2001. We were well into a bear market on the heels of the dot-com bust, and I remember this because it was my first day as a hedge fund manager. I had just left Lehman Brothers to start my own shop. I barely had any capital in the market. Suddenly, there was a headline that came across the screen saying the Fed would cut rates 50 basis points. It was a complete surprise, and no one was expecting it. As you can see in this chart and on the screen, the NASDAQ triple Qs put in probably its best day ever, up 25% intraday and closing up 19% at the close. As strong as that day was, it wasn't the bottom. In fact, the real market bottom didn't arrive until the following year. If you like the pod, please hit subscribe. And don't forget my full election breakdown podcast will hit this weekend. Comments, good and bad, or just give us a review, all are welcome. Thanks for joining. I'm David Nelson.